Ladies and gentlemen, I will try not to be muted next time. Welcome to the Big Tech Frenzy. You know how good that feels to say? The Big Tech Frenzy. We're so freaking back. Now, don't expect this to be a daily stream. I had a little bit of time tonight, and I just wanted to sort of go live and talk about my thought processes and not be live in the markets and have a bunch of questions being asked about, oh, did you just see this tweet that just came out and yada, yada, yada. So I can actually talk through some of what I'm thinking about on, names that I'm buying. So I wanted to talk about Meta and Google and Amazon and SoFi and Robinhood and a lot of these companies that I have, growing positions in that I'm not looking to essentially trim or get out of, and talk a little bit more through about how I get to those, those being exciting positions in my name. Talk about a little bit more about portfolio rebalancing, just a lot of the actual things that maybe I don't get around to talking about whenever we're just covering stocks alive each and every day. Okay. So, yeah, no introductory videos. No. I don't do the videos and the disclaimers and everything that Steve does. Obviously, all that already applies. Let's be adults. What I'm talking about with my portfolio is my portfolio. You guys have your own positions. As people say, if you're coming to YouTube to trust some kid about your investing thing, do your own due diligence. I'm just here to share my ideas. I'm an idiot. Okay. That's it. I'm absolutely no expert. I'm just trying to learn from the experts, and hopefully I can I can talk about how I'm thinking through that. Have a little fun. Cool. I only buy what Tanner buys. Don't do that. Okay. Let people know there's only a few hours remaining on the membership. Yeah, there's only a few hours remaining. Thanks, Sodak. In fact, we're going to be using Fiscal AI today as well. This is one of the best fundamental tools, and we're going to be talking through some of our things using this tool, which just so happens to be the partner of the futureinvesting.pro thing, which, yes, there is only a few hours, but less salesy, more actual due diligence. I'm going to have to drop chat for a sec so then we can actually see these charts. But Meta is a name that you guys know that I'm looking into. What I can do here is end up looking up all the companies. So I'm sort of on this Meg 7 chart here where I have, 7 different companies: Nvidia, Microsoft, Apple, Amazon, Meta, Google, and Tesla. Tesla, I'm not looking at, not because, it doesn't fit in here, but whenever we start looking at other metrics, it's going to throw it off. So I'm just going to remove that. So we're looking at sort of the other 6, because you can't really fundamentally look at Tesla. Even, the strongest of investors know that. It's more about what's going to happen in the future with Optimus and full self-driving and everything like that. And I'll let people take their bets on that company. I'm not currently invested. However, I have been for a long time. Okay, so let me remove revenue really quickly and look at price to earnings on these businesses. I'm also going to zoom into the most recent quarter where we can see that there's been a large sell-off on Meta. Okay, it's one of the cheapest companies in the Mag 7 from a price to earnings perspective. Nvidia actually being the most expensive, even though that's the largest position in my portfolio. Whenever we start to factor in growth on these businesses, so we can look at net profit margin here. If I hit the right one, did I? Yes. Okay. Net profit margin, you're going to see Meta spike down most recent quarter. Okay. Well, I'll talk through why that was, but the companies that even have the highest, margins, let's exclude this most recent quarter. And I'm going to show you guys, I'm not cherry picking data. It's going to look like that for a second, but I'll explain why in a moment. But the two companies with the best margins in the Mag 6, excluding Tesla, but if I were to bring Tesla in, it's not like it does any better. They're at the bottom. Okay. But in the Mag 7, the two best are Meta and Nvidia, which are the two that I'm getting most excited about. And the reason why is because net profit or net income is the factor of two different things. How can we take net revenue? What's the margin on that net revenue that flows all the way to the bottom line, net income? And then so if you're growing revenue and keeping your margin, then that's the level of net income that you're going to see. Okay. So if I take away this and bring up total revenue percent change, the two fastest companies that, I don't want to look at estimated growth. I want to look here. The two fastest growing companies are Meta and Nvidia as well. Okay. So they're the fastest growth on revenue, sales. Okay, how many new customers? What are they cross-selling those customers to? Are they buying their GPUs? Are they selling them advertisements? Stuff like this. Then, like I said, the margin is really good, which then flows down into earnings. And then that's whenever we look at PE. So this is the price that you're willing to pay for those earnings that we just ended up talking about. In the most recent quarter, Nvidia is at the highest, Meta is at the lowest. If we look forward, what is Wall Street expecting for the next, year? What we end up seeing is that Meta is at the bottom with a forward PE of 21 times, and then the second lowest is Nvidia at 26 times. So the same two companies that have the fastest revenue growth, the highest margins, are also the cheapest going forward. Guys, what am I missing? Okay, so then I would say, how do we think about the sentiment of these businesses, right? Like if I were to go into sort of my key pillars of investing, what's the moat? What's the product? What's the market dominance? Okay, this is where I think, you need to be really nitpicky, because even though Google was potentially a business that was getting super sold off and people thought that they had a previous moat, a trailing moat, ChatGPT came out of nowhere and sort of was threatening the thesis. Now that turned out to not be true, and they're still growing in search, and AI modes and AI overviews essentially just made their normal search still the place to go, but also integrated with very smart large language models. Meta has an extreme moat because the product that they are essentially using is, social media. And what social media needs is network effects. You're not going to a new social media if your friends or other people are not using it. Okay, so there are few companies that also play in this space. Reddit, X, like previously Twitter, YouTube, what we're using right now, TikTok. But that hasn't, first of all, none of those are extremely new. Maybe TikTok, you can say, threatened some businesses like Meta or maybe YouTube. But honestly, what they've proven is that Meta was able to integrate their version of Shorts, like Reels. It's some of the most profitable products that they've ever put out, and that they're extremely big on Facebook and Instagram and everything. It's actually propelled their business that TikTok has come out. And yeah, then I think, okay, well, what are some other parts of their business that is potentially threatening their business? Like, am I worried about, advertisements slowing down, or some other new name that comes into the space that could take away their take rate on advertisements? And the answer is no, because they own the platform, right? It's like saying, is Google threatened on their advertising platform because, I don't know, I can't even think of another name that could, because they decide the prices. They create the bid-ask system. Same with Meta, right? So I believe in the market dominance. I can believe in that because I see the amount of users. We can go back to Fiscal AI really quickly. And I'll just go to Meta really quick. By the way, so I wanted to say this as well. The part with Meta, if we go back to charting, because I was being nitpicky on the margins. So I want to clear that up. I said I would go back, and I want to make sure that I do. Did I hit the right one? Okay, wait, I have way too many selected. Okay, and then drag this forward. Okay, so you see this big sell-off on Meta here. Like the margin has absolutely tanked. We used to be the second most profitable business a quarter ago, 38.6% net profit margin. And then that sank all the way to the worst name in the Mag 7, down to 5.3%. I didn't want to brush past that, but I did need to get out what I wanted to say before. Now, they had a $15 billion tax charge, which counts as a generally accepted accounting principle. Okay, so you have to add that into your net income margin, but that doesn't necessarily mean that, that's something that we're going to see multiple times. And whenever you actually look at the functions of their business, it doesn't affect it. Now, how do we end up proving this? Well, we look at adjusted numbers versus standardized numbers. We can do this right here on Fiscal AI as well. So what I'm going to do is go to ratios, down to margins. I'm going to switch this to quarterly just because that's when it was affected. And then we're going to go to net profit margin, which is where we saw that crash, right? So that's what we just saw on the other charting thing. Then I'm going to go to adjusted. I'm going to go to adjusted net income margin. And then I'm going to go to the real numbers, because what they're doing is they're looking at estimated numbers. Why is that showing me that way? It's showing the margin also sinking, but that's actually not true. Okay, we'll look at it through an EPS lens then. It probably says it here. Okay, so it's actually saying that there are no adjustments stated by the company. That's why. But on adjusted EPS, there is actually adjustments stated by the company. Okay, so we'll do this through EPS then. Diluted EPS would also sink, right? Because that's just saying, hey, let's look at the amount of net income that that they saw, and then divide it by the total amount of diluted outstanding shares. Fully diluted outstanding shares, meaning that if they expect to see some sort of, dilution through stock-based compensation or vested packages of through employees that they are saying they will give them shares, but those shares haven't been given yet. In a fully diluted sense, you're saying, hey, well, what if we have to give all of these to all of our employees? What does that look like? Like, how bad can this get? That's fully diluted. And then adjusted EPS, you see two adjustments versus their normal EPS. One was over here. The actual EPS we saw $2.20, but on an adjusted basis, $2.60. For the most part, it stays very similar. But we actually saw on an adjusted basis, so this would be if we didn't have this $15 billion tax charge, would be essentially I can't see that. $7.30. I actually think it was $7.25 if I just move this decimal place over. Yeah, $7.25. Just rounding up. So, yeah, I'm not worried about that. In terms of Meta's business, you go, okay, well, how could they have avoided paying $15 billion in tax? Well, they don't. They got to pay their taxes. There's changes to the taxes that they have to pay. They have to pay it. Okay. Going forward, there's not going to continuously be these $15 billion tax payouts. It doesn't matter. Okay. So, someone says, hi, chat. Why is he talking about Meta? Because I'm buying it. Because there's been a large sell-off in this business since last quarter. And what I'm actually seeing is a company that's not only growing. This is what's cool about Fiscal as well. I can pull this line forward. So we've only seen to September. But once I go to December, this is what Wall Street's expecting. So you can see, well, it's the text is a little small, but there's like a bracket E. These are Wall Street's estimates. So if I also look at the estimated year-over-year change in growth, we're looking at essentially 20% growth, and that's assuming that they don't beat on earnings. Let me go ahead and see Meta really quick. How many times did they beat earnings overall? Meta has beaten revenue expectations 14 of the last 17 quarters. So the likelihood that they even beat these expectations is, something that I obviously want to have happened. Yeah. And then, a lot of signs have been put on, or pressure has been put on Meta because they have capital expenditures. So this is capital expenditures. This is a massive cost for them. This is property and equipment. Okay. There's a lot of companies. We can go back to charting here. Go back to Mag 7 and take that away. And where is this? Show capital expense. Did I hit the right one? No, that's CapEx to revenue. One above that. You know what? If I had a critique for Fiscal AI, they need to do like opposite colors so then I can see these lines a little bit better. My monitor's too close and too big in front of my face to be able to see across easily. Might get a little twisted. So across these 6 businesses, we are seeing a ton of spend for capital expenditures, which is the purchase of property and equipment. Okay, for future business. So although Meta continues to grow, Meta's not like Zuckerberg doesn't have his eyes pinned on, okay, well, what do we have to do in order to secure Q4 2025 earnings? He doesn't care about that. Well, one, that's already passed, but he's thinking about not only 2026, he's thinking about 2030, he's thinking about 2035, he's thinking about 2040. Okay. So that involves investing in researching products that are way out into the future. Things like not artificial intelligence, obviously everyone's focused on that right now, but things like VR goggles or AR glasses, augmented reality, doing a bunch of things that might be large products into the future that aren't very large right now. Okay. So I'm just a big believer that a lot of this spend, which a majority of it these days is actually spent on GPUs and setting up more data centers for artificial intelligence, would only then benefit my largest position in my portfolio. So I'm kind of placing my portfolio in a way that I'm betting on the AI names, but then I also have a significant investment in the company that benefits on the infrastructure layer, right? So all of this spend from the Mag 6 names that I'm looking at right now then feed into my main position, which is Nvidia. Okay, so Meta's loss, even though I don't think is one, is still my gain through Nvidia. All right. Sigig says, see my last comment. I don't see your last comment. Sigig, how long did you post this comment? I usually like reading your comments. Any chance you can copy and paste it? Okay, wait, I see one. Hi, sorry, missed the BMNR event today. How was it? Oh, man, I can't believe you made me read that. I'm not worried about that right now. Yeah, BMNR event was like, I think people's expectations were a little bit overblown for it being a shareholder event for a digital asset treasury. Like, they don't really have any products. I don't know what, like, they couldn't have said much. That said, some of the things that they did say in terms of the app, in terms of the reasons for investing in Mr. Beast, I thought were a little meh. Maybe you can do a poll on how concerned are you about Meta's expense, just to gauge folks' sentiment. Somewhat, yeah. It's all right. It's not confirmed that FinTech Friday will continue. Yeah, I'm not going to be doing the FinTech Friday. I just want to, it's way too late for me, so I'm still going to be doing streams with all of those guys. It's just, 10 o'clock to 12, essentially. Like once we do the after hours and everything, I was going to bed way too late. It was, yeah. I'm kind of on a health kick this year. And every Friday that I was doing that, my Whoop was like telling me, they're like, oh, something's going wrong. Like, you need to get to bed. You're way too wired. You're sitting in front of 4 major screens. It's just a lot. Like, I don't know if people can see what I'm sitting in front of, but it's a lot of lights and a lot of monitors. I just didn't want to be up that late. So it had nothing to do with them. I'm just going to do more earlier shows. This is by far the latest you're going to see me now. Tanner, well, I just told you. That's the reason. I got to listen to the Whoop. Exactly. Okay. But let's get back to the investing. We're investing these days, okay? Really quick, I wanted to bring that. Okay, another thing that I wanted to really focus on as well is founders, right? I want extremely, like I think that there's levels to being a smart not investor, like a CEO. And whenever you take a look at Meta, for example, you're talking about this, I think Zuckerberg's 42 years old. Let's see. 41. So he's 41 years old. We probably have like legitimately 30 more years with him. You know, he's in good health. I'm not worried about him as a founder. He's in an area where they are literally able to start up new business lines like Threads, for example, and see hundreds of millions of people potentially look to that app just because Zuckerberg just created a carbon copy of X. Like, their moat, the unbelievable sizing of the company. So we can take a look at this through Fiscal as well. If I go to financials here and then drop CapEx, we'll go to segments and KPIs. We'll switch it to quarterly. And then, so one, we should also look like percent change. This is of, well, this is advertising dollars. I wanted to see, can I not see daily active person by geography? I could have sworn, okay, maybe it's here. Rest of world average ads. Anyway, I'll show this up for a second. We'll take a look at this. This is representing over 3.5 billion people that they have on their platform right now. And the growth rate is at pretty great. You're essentially looking at the similar growth rates of what we saw in December of 2023, for which we haven't seen that since December of 2021. If from these past trends that we've seen that December is usually a very fast, December of every other year is a very fast time, then this could mean that the number of daily active users that we're about to see this quarter might actually be one of the faster growth rates that we've ever seen. Okay. I'm loving everything I'm seeing about this in terms of the advertising dollars that I'm seeing from Meta on a per person basis, on the growth internationally, especially as more people are even coming online, more people are getting access to cell phones, high-speed internet access. They're coming online, and the number one social media platform by far is Meta. The spend on advertising dollars, I think, only comes to further their not only growth in targeting for new potential users and potentially getting into new apps and new services, but also their ability to convert into real advertisements and have people potentially buy what another business is selling. That leads to higher monetization for Meta, faster growth, more users. It's founder-led. So I believe that there's a management here a culture of continued improvement and not slowing down. Essentially, we're looking at a great financial velocity from the growth rates at being plus 20%. Most recent quarter was 20.6%. So next quarter we might beat, but this is the information that we actually have here. Okay. September of 2025, we did 26.2% growth. Like, what are we talking about? It's just phenomenal. I'm mind blown by this company. I'm similarly mind blown by other names. Meta. I wanted to do. Okay, I can still do another 35 minutes or so. We got a blitzkrieg through a couple of these names. I wanted to talk about Nvidia, Nebius, SoFi, Robinhood, a little bit of eToro, how I explore new names. I don't know how I'm going to have any of this time, but Nvidia. Let's talk on this for a second. Why is this reversing my data? Okay, there we go. Nvidia, this is by far my biggest position in my portfolio. Makes up for 40, I'd have to check my exact amount. I think it's 41% of my portfolio. And the reason why I'm looking at a name like this is, one, just like we saw from TSM, the build out is probably a lot longer than people initially expected. And that Dan Ives, as much as I, not that I don't want to agree with him, but I feel like he just says like times. He's like, yeah, it's 10:30 at the party. I mean, like, it really is 10:30 at this party right now. The fact that TSM's capital expenditures had skyrocketed so much. This is not gonna. Can I get the American listing, or can't I go here? TSM, there we go. Okay, so if we look at capital expenditures, why aren't I seeing the most recent quarter? I wonder if the Taiwanese name has the most recent quarter or not. That doesn't look right to me. That's not the number I remember. Let me go see what it was. But essentially, they wanted to spend in US dollars for next quarter an increased amount of capital expenditures to $52 to $56 billion. The only way that they can ever, separate themselves from that amount of capital to go and start to break ground on new facilities to set up, foundries that are going to end up cutting and selling new chips to companies like AMD and Nvidia and all of these, if they believe that those companies are still going to show up to buy those chips from them in order to deliver them to their end customer, which might be a Meta, an Amazon, a Nebius, what have you. Not Nebius, sorry, I should have said, Amazon, Google, Nvidia, AMD, Broadcom, those types of names. So, what was I going to say? So the fact that they have this runway, that they believe that those customers are going to continue to come to the plate and buy more and more of these chips gets me so excited. I have full belief in names like Nvidia that they are going to see this $500 billion worth of sales over the next 5 quarters, if not even more. And yet it takes you no time to take a look at estimates on this company and see that Wall Street is not anticipating that they reach those estimates at all. Okay, so we can take a look. They're expecting 65 billion, which is a massive improvement from where it was. They had, essentially you can see this from November. How much, like if I remove my mouse here, that massive tick up right here, the massive tick up that we saw from expected growth whenever we ended up seeing their latest earnings results. Okay. That tick up essentially told Jensen told, investors and Wall Street, guys, all of your expectations for this company are so much lower than what you're what you're really realizing. If you look back here, this is what they're expecting for, which one's purple? This is probably Q1 of 2026. Back in May of 2023, they thought they were going to do $14.4 billion for that one quarter. Then, as time got around, we actually ended up seeing that quarter. That $13 billion turned into $43 billion of expectations. They tripled what they expected that one individual quarter to do. That is insanity. Okay, that is such an insane revision in growth. And you can see this for all of their quarters, that they've only revised them up and up and up. Okay? If you look forward on their current expectations, which I think will continue to be revised upward, we are looking at 65 billion, 70, 77. Well, I should go to median, but 76, 85, and then $95 billion over the next 5 quarters. Not one of those quarters is an average of over 100 billion, and they all need to be in order to hit that $500 billion target. Not one. Some investors or some analysts are calling for 130 billion. But look at the separation between the highest and the lowest on Wall Street. This is how different two Wall Street investors from different teams can see this business playing out. That by January 27th, we're either doing $68 billion, which is roughly what we're doing this quarter, which there's analysts saying that we might do only 62 billion, even though Jensen has said that they're going to do 65 plus billion dollars, and they haven't missed earnings in a very long time. Or instead of 68, you're going to do $130 billion. Look at the widening on as Fiscal AI sort of plots this out. The widening is showing the divergence between Wall Street getting this name right or wrong. Obviously, I favor the high end of this because I listen to all of the biggest players on in Silicon Valley and in markets in general. They're all saying, hey, we need to buy more chips, Meta being one of them, right? So, sorry if I seem like this name is not rightfully priced. That whenever I take a look at growth rates, which it's so funny how Wall Street works. Back whenever we were here a quarter ago, and I remember having conversations with people and they looked at this chart and they said, yes, I mean, obviously holding this company through 265% growth is insane, but the growth coming down is only going to continue to come down. Eventually we're going to hit 45%, then 40, and eventually this is going to head all the way down to 20%. And so Tanner, what are you going to do if this company is being priced to perfection, quote unquote perfection, but growth is only getting worse over time? But if you look out forward, then that isn't what happened. We saw a step change in growth, like a massive, going from $46.7 billion to $57 billion quarter over quarter. Then you're like, okay, well, you can't keep doing that. Well, next quarter, Wall Street has them doing 66% growth, faster than last quarter, and it continuing to accelerate. So one of the key pillars that I find whenever I'm looking at companies that I want to double and triple down on are revenue growth accelerating and margins expanding. Nvidia has both, okay? And they're doing that in a hardware space, which a lot of people would call a a negative to their business, but really what it is a manufacturing moat. Like the barrier to entry, because they need to have 200 different partnerships across the entire world, and they work with every single software company in the world in order to give their chips out for artificial intelligence. Like replicating them becomes nearly impossible, right? You only have a few names that even have the brain share, the technical expertise to even compete with them, let alone try to beat them, right? Huawei just sported that they potentially are helping some Chinese native companies not need Nvidia GPUs, and that they came out with this new LLM that was all ran and trained on Huawei chips. And then what you realize is that the chips that they could have went to were H20s, not H200s, which we just got a green light for both sides, which, by the way, guidance is not the 500 billion that I was telling you about, not even remotely in that factor. Okay. So you have potential China sales opening up for the H200s. The H200s, that's old school tech. You know, they're sporting that they don't need to use Nvidia, and they're talking about 2 architectures ago. Now we're on Blackwell, which has had an upgrade already. So we went from Blackwell to Blackwell Ultra and the GB300 NVL72s, all the way to now what they're talking about is the Vera Rubins, which is expected for essentially in the midpoint of 2026, which then also will have an upgrade for the Vera Rubin Ultra. How do you even compete whenever they're making step changes in their advancements every 6 months? You know, it's impossible. So I got to love this. Got to love it. And then, by the way, after Vera Rubin, Vera Feynman also has been announced. So they have some level of roadmap into new breakthroughs that they believe they can implement in new GPUs. The same way that the iPhone would hold back on upgrades, or Samsung TVs or something like this would hold back on upgrades, so then they can have a roadmap of putting out bigger and bigger, flatter screens, nicer designs, and continue that sales cycle. They're also doing this at an enterprise level while charging unbelievable 75% gross margin fees. Like, imagine making a product for $100 and selling it for $400, sorry. And all of these companies can't do anything about it. What's a price that you would put on that business? By the way, also, longest ran large tech company. Love the management, love the culture of that business. Everyone knows that, you know, the average person that worked for Nvidia, the engineers are all worth like $25+ million because their stock options had, you know, skyrocketed through the roof. So they can get any level of brain share that they want because, you know, every single person there drives a Lamborghini, and, you know, the lifestyle, the brain share of Nvidia, it all just goes to further their moat. That's why I like the business. But just my belief right now. What's another company that we should cover that's more broad-based? SoFi, maybe? So SoFi, I'll keep this one short just because I'll do sort of a 3-parter here. SoFi, I'm doubling down on. I do not think in any form that this 10% credit card cap is going through. Okay. I think it's already abolished. I think, like, there was a comment today about Trump saying that he believes that there's going to be, that he's going to work with credit card companies to help them come down on prices. A lot different than putting a January 20th deadline and saying you need to come down to 10% to, hey, let's work together. That's a big step change. So I don't think that much is going to change there. And it's not even a large percentage of their business anyways. The real benefit to their business is credit card debt consolidation, which might actually be the solution that Trump's looking for, and Trump is well positioned, or SoFi is well positioned. Same thing with federal student loans. The federal student loans are potentially a problem. SoFi has a very great solution, which is great underwriting on private student loans, and alleviate some of that debt solution that the Federal Reserve is having, or the federal government is having. So I believe that SoFi has not cut a lot of corners, and they've taken the hard route, less traveled very often. And so whenever there is a real problem and new regulation needs to come about, they're usually not in the crosshairs. Okay. So that's another core pillar. As we're going through my core pillars of what I look for, I don't need a founder-led company. Tesla is not a founder-led company. He's a quasi-founder. He came in really, really early into the business. He changed the trajectory, right? Anthony Noto, I feel very much the same way. He's not the founder, but boy, oh boy, is that his adopted child, okay? He believes SoFi is his child, and I believe him. Okay. What we ended up seeing on SoFi's website traffic is that If we extrapolate out, I have a little chart here. We saw from SimilarWeb that October, November, and December, we have all of that data now. What we ended up seeing is roughly 71 million visits. And I'm aware this is an app-based company, but think about it as a large survey. 70 million visits in a quarter is a pretty great survey versus polling potentially 4,000 or 5,000 people and trying to decide where the election is swinging. You know, like this is a pretty good survey. Regardless, what we ended up seeing is a continued increase in more, new user adoption. And this has led me to realize that as this was correcting and turning around, these are the 4 quarters. You can go back from Q1 all the way to Q4 is where we started to see the member adoption explosion. Okay. New customers coming onto the platform, getting new products. SoFi is starting to pay more and more and more. Their sales and marketing budget goes higher. But it's the level at which that's changing. So for example, now we're at 46.2% growth year over year. A massive change to where we were last Q4 of 2024. It's the fastest growth rate. So we have growth accelerating on new people looking at the platform, using the platform, and whether or not that's new members or existing members coming back to the platform, usually it's some form of revenue generating activity, right? So if you're coming back to use SoFi Plus, if you're coming back to pay your loan, it doesn't really matter to me. You're using the platform, right? It's a bank. But what's it called? Not only do I think that they have the engagement for Q4, but all of the sort of signs of good invest activity that we saw in October, not so much in November and December, but it's not a big portion of their business. And then we saw SoFi Money, a need for SoFi personal loans, home loans. That was a big explosion as well. And student loans, all hitting off at the exact same time right now. Those are some of their biggest revenue generators for them. The loan platform business, we saw, deals being signed there. We saw a $700 million, loan deal end up getting signed. We saw Chime from their earnings results say that there's a $33 million fine that they're paying Galileo for leaving the platform early. We already knew that they were leaving. The accounts are already off of Galileo's platform, but they haven't officially, paid their last check. That was expected to come in Q1 of 2026. Turns out Chime wants to pay it Q4 of 2025. If they pay it Q4 of 2025, that could be a big upside on revenue that not many people are expecting. What else? 10 plus deals for Galileo being signed throughout Q4. So they expect to end the year with a lot of new contracts signed there. Could also be some signing bonuses. But yeah. Very excited about SoFi. I cover that one a lot, so I'm not going to go super deep on that one. Hood's interesting. We can talk about this one. Let's bring back Fiscal AI. I'll just show you guys this because it is insanely useful, this tool. Like you guys know, I build a lot of charts. You've seen a lot of them, and it's actually forced me to use less charts. I only need them if there's certain businesses that don't track well. BM&R, there's not a whole lot to do on charts. Toro is such a brand new business, so I needed to chart a lot of that to write down some of their numbers. But yeah. For Robinhood, if we take a look at this company, what we ended up seeing is last year, Q4, seeing a massive explosion in new revenue growth. I came in the business about this part, right? So if I even bring this back, I won't go too far back, but growth was meh. Then in March of 2024, they started showing a very real change in their KPIs. And although it was much more expensive to pay for them in March of 2024, so if you would have invested back here, you would have been paying $8 for this company. Once you got into this range, you were paying sort of the $16, $17 range. But I started to see the actual turn. So for me, sometimes it's better for me to actually see the execution happen and pay a higher price than to bet on the wrong name and continue to see it, be stagnant. Same thing with PayPal, why I've abandoned that name. Well, I believe in management and a lot of things that they've said. I'd rather just buy them at 70 or buy them at, 75 or something like this and actually watch the fundamentals turn around, the growth start to reaccelerate than me, wishing for that to happen and not knowing where the bottom is. That's just personal preference in terms of how to enter those names. But this was the main catalyst. So we saw March, June, September, phenomenal in 2024, but it wasn't anything like what we saw in December. And that was mainly a big crypto boom, but we essentially saw 40% growth quarter over quarter. Is just insane, right? Now people are wondering, because once we head into this next quarter, the quarter that we're lapping, so this most recent quarter was 100%, it was like 99 point something percent growth. I can bring that up. Yeah, it literally says 100 here, but I'm pretty sure if I change the decimal, it was, okay, 100%, and I lied. But essentially, if we end up taking a look here, that was off of this quarter, the one that was sort of whenever we were doing much lower numbers. The quarter that we're about to see is, going to lap this massive quarter that we grew at 115%. So we're not seeing 100% growth on top of this. We're not about to see another big jump, especially not with the markets that we saw in November and December being a little bit more, suppressed like it was in October. October was extremely strong in every area. But if we go out and we take a look at the quarter that we're expecting, Wall Street is still expecting 32.8% growth on top of the best quarter that we've ever seen. Like, that is strong. That is so much strength that they're proving to us. And that's on better margins because Robinhood has essentially just built their entire business for scale. So the more activity that they actually get, the better margins that they get, and they get to charge the best prices because of the way that they've set their business up. So, although this revenue growth overall looks like it's going to be, shrinking a little bit, especially in the market that we've been seeing in January, it's very strong. March is at a lower comp for, Q1 of 2026 that we're about to see. And so these growth rates will reaccelerate after this. Okay. So look out for really the segments that they're taking over to sort of gauge that growth in their multiple. You can look at any operating expense. We don't really have capital expenditures. They still have a huge cash balance, no debt, like very strong business in that regard. It's mainly whenever you're looking at a company like Robinhood, we're focused on moat, product differential, founder, and what are the valuation risks? Now, that's the new one. And valuation risk is a concern. So that sort of will draw me into the next company that we take a look at. Now, like I said, it's harder to look at this business. And in fact, it almost would not make sense. But it's harder to look at eToro because there's so many things that we have to understand as caveats. But I'll do my best. So Robinhood, whenever we take a look, not at their margin, sorry, I actually want valuation. If we take a look now, they're a $102 billion business. And this happened very quickly. Okay. We just look at the last, 2 years? We've gone from an $8.7 billion business to a $102 billion business in 2 years. That's kind of crazy. Maybe it's 3 years. Yeah, maybe that's 3 years. 1, 2, 3. Yeah, 3 years. That's unbelievable. But you can just see the way that they enter every product. It's like the credit card that they put out was unbelievable. The prediction markets that they did just caught steam and they became, the second largest prediction market company overnight. Like it's hard to argue with that sort of success. So clearly there's things that they look for and that is catching steam. Okay. oh, sorry. Actually, I wanted to look at valuation. Sorry. I have ADHD, guys. You guys have to realize this. It's terrible. If you look at trailing PE on this business, you're looking at a 47.9 times. I think the Schiller PE for the S&P 500 right now is something like 30 times, 29 times, something like this. And that, honestly, that's historically high. Current Schiller PE is 40 times, nearly 41 times. The highest it's ever been is 44 times December of 1999. We are getting to like .com level. That's actually crazy. I did not realize that. Look at this. Technology is just, that's nuts. I'm turning this bullish video into a fear and FUD story. All right. Regardless, Robinhood is still a very expensive valuation at 40, plus times on a PE basis. And that's because their multiple is actually pretty good. If you look at them from a price to sales basis, it's also very high, now 24.3 times. But that's extremely high versus their competitors. You look at like what's SoFi on a price to sales basis. It says 9.7, but that's going to come down. Why aren't you loading? There we go. 9 times, 9.19 times on a price to sales. Robinhood's is 30. It's expensive. eToro's is not actually going to give us a proper price to sales. It's going to say something disgustingly low, like 0.17. That's not really true. Okay. The reason is if you guys cover Block, you'll know that all the crypto that transfers through Block's ecosystem counts as revenue, but it's not actually revenue. It just means that their cost of sales is really high as well. So you look at like this, for example, they're not doing $4 billion in revenue because the cost of goods sold is equally as high. Okay. So you're not actually making this revenue. So what they do is, in fact, they track it as net contributions, total net contributions. This is actually their real revenue. Okay. And then whenever we look at percent growth on total net contributions, we are still growing at roughly 28%. So it's nothing like what you're going to see at Robinhood, but still, whenever you're looking at a company that is taking market share, is growing at 215 million, still is founder led. So I don't even own this company, but I'll try to tell you how I'm thinking through this. The valuation and risks is so low on this company, while the moat is definitely missing. They have a couple products that I think would be easily replicated, like Copy Trader and stuff like this. I don't really think those are moat creating businesses. So whenever I see a company that checks every single box, right? I kind of have like 12 boxes that I want to check. Then I try to go all in on those businesses and invest heavily. eToro is not really checking all the boxes, but it is founder led, engineer focused. So they are focused on product. The valuation is so unbelievably low that we're not even really in any sort of valuation concerns. They're a $2.4 or $2.6 billion business, not a $102 billion business. And 1.2 billion of that is in pure cash. Okay. They're profitable, free cash flow positive. They are in a low capital light generating business. It's just something that I'm looking into. And because of my expertise is used very lightly, because I own other fintechs, I feel like I know this industry, but I'm no expert. Okay. I try to study the experts, but we're young and learning. That said, eToro is in a space that I know, total addressable market that I understand, 75 different countries, reducing geographical risk, fast growing, market share taking, founder led, and unbelievably cheap. Now, I've done better with buying companies that I think are market leaders, but also expensive, like Robinhood. but there's definitely money to be made on buying cheap companies as well. I just got to narrow it down. But yeah. eToro had crypto since 2016. So eToro actually had Bitcoin on their balance sheet since it was $5. That's a true story. That Vitalik Buterin, if you guys know that name, he's the founder of Ethereum. Back before he created Ethereum, went to eToro's office to interview Yoni, the CEO and co-founder of eToro, about Bitcoin back whenever he wrote blogs for Bitcoin magazine. I mean, they are crypto, like, they're from the beginning. Okay. So, yeah. Let's see. What other names? I don't have too much time left. So maybe we can do one more. What's another company? Do we want to talk a little bit about Google? This is a company that I think, by the way, I want to talk about the moment in time that we're in right now, just while I finish this up. Okay. The Mag 7s, please, please, please stop just looking at market caps and saying that things cannot get bigger. They absolutely can. We are going to live through an era where the richest man on earth is a trillionaire, literally a trillionaire. Okay. It was a couple of years ago when the richest person in the world had 100 billion. Warren Buffett was strutting his stuff. I actually think it might've been Bill Gates that passed the 100 billion first, but anyway. Market cap is just a multiple. Well, it's just the added up amount of shares. But if as long as they can continue to generate more and more earnings over time, then the market cap can continue to expand. Okay. I love Google because you can find two different investors, Brad Gerstner and people like, what's the French super investors? Oh gosh. They're two brothers. They own a very, very tech and AI forward business. Anyway, they bought into Google recently as well. And so did Warren Buffett as well. Warren Buffett's team bought Google as well. So these companies are being looked at as growth, AI, super names. And then on the other end, they're being looked at as value, sustainable moats. They're not they're like quasi founder led in a different direction. Like, yes, Sundar Pichai is in the driver's seat, but Sergey Brin, Larry Page, they're still coming back and monitoring this business similarly to the way that Jeff Bezos is with Amazon. Like they're kind of stepped away. They don't have to show up every day, but they're working very hard. Okay. Courtier Management. That's the one I was thinking of. Courtier Management did the Courtier Magnificent 40, which the original version of that didn't even include Google, which was the opportunity of a lifetime. Everyone counted Google out. You guys know, early on, I was wrong, okay? This company got sold off in sort of 2022. I was not a believer. However, as we sort of aged, I did believe this company, and I still ended up making a crap ton of money even after not believing. So was I the earliest? No. Did it still allow me to make a fortune on this company? Absolutely. And I continue to think that I'm going to make more money over time because this company is just expected to continue to expand revenue. Every quarter going forward, they're not expected to make less than $100 billion in revenue every single quarter. You're right, Rob. It's Fantastic 40, not Magnificent 40. It's their Fantastic 40. But part of the thesis that I believe in with Google is sustained revenue from their existing business models. Search is maybe one of the greatest industries. They are quasi-founder led, fantastic, or at least improving culture for Google. No longer trying to hinder the business or protest in the CEO's office because they're working with government. All of that is going away. Okay. They're realizing that they actually do need to be, a little bit more fiscally responsible, and that their moat will be threatened if they don't move fast. So, but you have a hardware space, you have cloud, and then that ties in with everything that I believe in with all the other companies that I just looked at. Meta, Google, Nvidia allows me to research a couple areas, right? The AI technological space that as a theme, and still tie that into my other investments while getting size, quality, fast growth, accelerating growth. You know, that's another thing that we need to look at. Go to quarterly. This is a fast growing business with accelerating revenue. Okay. We're at 16%, but a couple quarters ago, people were worried that was going to shrink. Like we're in growth mode. This is year over year growth on freaking Google. You know, it's fantastic. Anyway, I won't keep you guys here. I should have done 2 more hours of this, but as Sodak Zach said at the beginning, there is only about 2.5 hours left on the futureinvesting.pro deal. So you can get about a nice deal off that. And then I never run promos ever again. And I partnered with Fiscal AI. They'll give you an entire year of this product that we were just using, what I use every single day for my thing. I do daily member-only live streams talking about my entire philosophy of investing, hopefully finding great names. But regardless of whether or not you want to support me in that direction, I'm going to be live here multiple times a day, regardless. So I'm not changing the way I run the YouTube channel. I'm actually just forcing myself to be more busy and study the markets even more. Just with a little bit more of a tighter knit group that actually allows me to be a little bit more open in, you know, what I'm talking about in terms of my actual position sizes, you know, what I'm actually moving. We can have people on to discuss their portfolios. So we can kind of craft and do what we want on those hour-long daily live streams. Yeah. And if you have any questions, there's a bunch of people in Discord. You'll see them with green names. Just ask them if the product's legit. They'll tell you. For real, I've not had one. I swear, guys, I'm aware what like courses and all that shit sounds like. I just want to offer, like, for real, the best product that I can offer. And if at any point that people feel like I'm not offering that, then you know, we're going to change and pivot to offer something that. But obviously, the Fiscal AI thing, the daily live streams, I think it's a fantastic thing, and we've been doing that for 2 years. 2 years. Legit, one person, or sorry, once you enter, there's not another payments. I don't ask, there's no upsell, no anything like that. So, for real, like even the original price that I had on that thing, which was less than half the cost of what it is now, I'm still offering all the daily live streams and everything to those people that, you know, entrusted me 2 years ago. I hope your Whoop gives you 100% sleep score. My sleep score almost always is 88 or plus. Most of the time, it's 90+%. Fintech Fridays, please. It's a good product. Yeah, it's mainly just on my sleep. I'm just worried about that. I want to start winding down, getting away from the screens, doing a little bit more reading or my saunas at this time of day. So that's really what it's about. I'm still going to have conversations with Roy, Tevis, Steve. It's just going to have to be at a different time. I think Steve and I have a show on Wednesday. Just came in. Well, I'm just heading out. You can go to futureinvesting.pro. Check out the deal. I think we got 2 hours left. Enjoy. You can check out the description. It's also there. Whoop is so expensive. Get a Garmin. No. Whoop's not that expensive. It's $20 a month to take care of your health. And I don't have to take this thing off. The battery lasts 15 days. And then whenever I do charge it, the thing just slides right on. It still ends up taking my skin temperature and everything like that. So I like the Whoop a lot. I take it in the sauna. I take it in. I did hot yoga. This is how crazy the Whoop is. I did hot yoga with my girlfriend, had it on, absolutely died, by the way. Whenever I got out, it said hot yoga detected. I didn't plug that in. I didn't tell it I was doing hot yoga. It knew by my movements that I was doing yoga. Has it been 100% correct? No. I shoveled my driveway earlier. It thought I was doing field hockey. You know, it's got some learning to do. But it did know hot yoga. That's pretty cool. Is this sponsored by Whoop? No, I just like good products. This is sponsored by me. It might be sponsored by Fiscal AI. I mean, that if there was a sponsor, it's them. But for real, they just hooked me up. Like, you guys have no idea. An annual subscription to their product is $480. Okay, the version that I use is the one that's above that. I don't. Was it $960, something like that? $960 a year. It's expensive as ever. But the 480 product, they said, if people go and they buy your membership, we'll give them one for free, because I was one of the top ranked people on their leaderboard in terms of like people that were working with them as affiliates. So you look at like Chris Patel and Roy and Brian Feroldi and all of these guys. I was like, I think third, and I had started that month. So for real, they love me there. I love them. And they're just hooking me up with an insane freaking offer. So, and then on top of that, you can get 50% off every year after that. Well, I'm not supposed to say 50% off, but I charge $20 a month or 100 or 240 or whatever for Fiscal AI Pro going forward, which is 50% off. I can't say that, but crazy. So you can't get that anywhere else. Like, Fiscal AI does not offer that promotion themselves. That's only me. That's that type of offer that I'm trying to give you guys. You guys have no idea. Like, it's hard for me to offer you guys that. And I can't, but just shush. Okay. You sweat while doing yoga, hot yoga? Hot yoga is in a hot room. They heat the room. I guess any yoga is hot yoga, but it's hot. It's like a steam room. Is Tanner out of the fintech frenzy because the bullying by Steven Tevis? Or is this more for sauna time? Chads must know. Bullying by Steven Tevis. These are some of my best friends. Steven Tevis called me like, a lot. They'll just like, Tevis called me today. I'm good friends with all of them. I'm just, I want my own time. You guys won't see really late streams. I'm 8 minutes past how long I want to be late right now, or how long I want to be live. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But bye for now.